Hello, everybody. This is Rob with Maverick. Nice to see you. I know you were expecting Joe, and I know you're probably disappointed, but Joe and I are switching up. He is going to be taking the trading room this weekend as I'm out of town. So you've got me for the midweek update, March 8th. So let's go ahead and get into it. I want to just cover what's been going on this week. Not that we expect you don't know this already, but this is always a good place to start with where we were for the week and kind of some of the changes that have happened since the weekend. All right, we got some pullbacks, and we're going to go into the charts here. We got a really big doji at resistance at the 20 MA on Monday, and then Thursday, Chairman Powell came out and basically killed the rally. Killed the rally, basically saying that they're going to need to raise interest rates even more than the market expects and for longer. And the market did not like that whatsoever. So we had a big down day yesterday. And we are also seeing the US dollar strengthen. This strengthening of the US dollar is actually putting some pressure on international markets. Now, I'm a little surprised that industrials weren't hit a little bit more because industrials are usually very sensitive to the dollar, but industrials held in really nicely. Industrials were one of our stronger sectors that we were looking at for this week. So when bad news comes out and it doesn't move it down, it actually is a nice sign that we're at least looking at relative strength at the moment. Let's take a look at some of the economic news that has come out, because the economic news also supports higher interest rates than the market wants. So this morning we got ADP employment report, and you can see that number was hot, 242. That's a hot number on there. And look, we have the payrolls report on Friday, which is really going to be the one. But again, much stronger than expected employment number. Another thing the Fed has said is they are looking at job openings. Now, this JOLTS job openings number has never mattered until the last 6 months. This is a report no one cared about until Chairman Powell came out and said, we want to see these come down. These have been stubbornly over 10 million for a long time, and you can see we are still much higher than expectations. They kind of said they want to see this come down to like 8 or 9 million. All of these numbers are showing that the Fed is still behind the curve here on the fighting inflation, at least on the employment sector. We do get our payrolls report on Friday, so that'll be the final number, and if this number comes out hot, it should put some more pressure on the market as well. This week, we already have, again, the market really rallied off of the belief that the Fed was done and the Fed wasn't going to raise much more, and the market is having to rethink that. We've got the 10-year bond ran up above 4%. It's back down to about 3.9%, but everything here is saying that the Fed is going to be trying to slow everything down even more. So let's take a look at how the markets reacted today. So this week, we had a 0 on the week and a 0 on the month. We're at this inflection point. At this point, the Dow's down 1.8%, S&P's down 1.3%. Look at the Qs. The Qs are holding up. Large cap tech is holding up much better than everything else. And then look at that Russell, that IWM. The Russell is the weakest place right now. Again, this is most likely because of Fed and interest rates. It makes it more difficult for smaller companies to raise money to continue to expand and grow. Oil down, basically the exact opposite of what it gained last week. So whatever it gained last week, it gave up. Gold, same thing. Went up like 2.2% last week. We've given back 2% this week. So let's really focus here on the charts. Now, I want to talk about yesterday's candle, because yesterday's candle came off of this reversal candle. So we had this big bullish engulfing candle. We had a nice follow through, and then we ran right into overhead resistance, so that 20 moving average, and it tried to hold, and it just couldn't. So we got this expanded range candle yesterday. Okay, now if you've listened to me for any amount of time, you know that I always talk about the most likely candle to get after an expanded range candle is a Harami candle. Now, Harami candle, if you have a red candle, you basically take that big candle and you cut it in the middle and say, okay, the next candle is likely going to be somewhere within this range. If you have a bullish candle, you just do the opposite thing. You say, okay, the next candle is likely to be in this range somewhere. I fully expected that we are going to get some sort of a Harami pattern today. And you can see we had a little bit of weakness early. At this point, we've recovered a little bit. Okay, this isn't a big candle, especially when you take a look at the size of the candle next to it. I think that Thursday is actually going to be the day. If we can rally Thursday, I think that this market probably holds in quite nicely. And at best, we are sideways, probably to our last high and to our last low. Excuse me. I think to our last high and our last low, I think we're going to be in this range. If, however, tomorrow is a big nasty red candle, then I think you have to start taking a look at this prior low that happened right around 392.50 on the spiders and say that that is at least going to get tested, if not broken. I am more bearish than bullish here, but it's like 60-40. And that's what Darren said on the trading room over the weekend, was that he was 60-40, 60% on the short side, 40% on the upside. That's not a bold call. And that's definitely not bold enough to put a lot of capital into bearish trades. So we still think until we get some more breakdowns, we need to be a little bit more balanced here. But I think we all need to be ready to start thinking about getting a little bit more bearish if we do get that red candle tomorrow. We'll have to see what happens. That being said, this is the spiders. You take a look at the Qs, and boy, the Qs are telling a different story. We didn't have as big of a candle on the Qs because they held in better. They rallied more and they fell less. So right now it's telling us that big cap tech is actually holding in really nicely. Now look, if we get the same thing tomorrow, a big red candle, okay, then I think you have to take a look at these support levels and say, okay, is it going to hold? Are they going to break? But at this point, if I'm looking to be bullish anywhere, large cap tech looks really good here. And luckily we're in some large cap tech trades off of the trading room, so we'll take a look at those here in just a second. Then we come over here to the Russell. And the Russell is already down to these support levels. We could get a major breakdown in the Russell tomorrow. And if we get that big red candle breaking below that 50-period moving average, then all of a sudden the Russell is more like a -2. So hopefully you can see where we are here. We've got the S&P that's really at a 0. We've got the NASDAQ that's at a +1. We've got the Russell that's at a -1. It is still a really choppy market here. And I shouldn't say choppy, but just we're not getting any clear signals of where the next move is going to be. And so, just like we talked about this weekend in the trading room, we are still at the point where you want to be more neutral. You want to be making wimpy trades and you want to be making less trades. This is not one of those points in the market where you've got green lights to go long or short, everything looks good, things are moving. That's not where we are right now. Right now, we're at a situation where it's not all that clear. And so the best thing to do is we call them chicken bulls, chicken bears. So very small spreads at the money, not asking anything to do all that much. And then really focusing on the sectors, really focusing on where is the strength and weakness in this market. So we had our favorite sectors were comm services and industrials. And you can see the comm services actually performed the best. They're up 3% this week, looking really good. Technology is up about 0.2%. But you can see materials, tech, real estate, utilities are all up for the week. And then you've got a lot of things that are neutral: consumer, financials, industrials. And the weakest sectors are energy and healthcare. Now, I want to point out that energy is weak, but this has been in the face of what were stronger oil prices. The market went up. The oil market went up yesterday, and the energy sector went down. That's always a little tell to me of where the sector is going, is that if you take a look at the chart of oil, maybe we'll take a look at that here in a second. It is low basing. It has come down from, the 130 that it was after the Ukraine war started. And we've come all the way down, and we've been bouncing around the 73 to 80 area. And it looks like we're headed back down to the lower end of that range. But while these spikes were happening towards 80, the energy sector wasn't really responding. I'm actually starting to like energy more and more as a short. It's not there yet. We'll take a look at it. But to me, energy is showing some underperformance, and healthcare has been on our negative list for the last month or two. It's looking bad, and it's continuing to perform not all that good. So again, materials and industrials were our favorite sectors for the week, and they are both up for the week in the face of a down market. So we're in the right place. Ironically, though, we had real estate and utilities on our negative list, and they've been the two out of the three best performers out there. So the things that are really still working here, healthcare weakness and materials and industrial strength. They are actually showing that, okay, these do want to stay strong here during this time period. So ultimately, this is where I am. We started the week at a 0 and 0. I'm just going to back off my weekly outlook here to a -1. The big reason for this is that this news about the Fed has really caused the market to not be as exuberant. This big rally that we had at the first start of the year, a couple things started happening. All of a sudden, at this point, the interest rate situation looks much worse than it did just a couple weeks ago. And I think the market's going to have a hard time rallying on that. So at this point, I'm looking to be slightly weak, but I said 60-40. 60-40 is about as bullish as I can get here. So let me send out a poll here. Let's see what your weekly outlook is for the week. So if you're in here live, go ahead and answer the poll, and I'll share here. I'm going to give it a couple seconds to let the results roll in. All right, well, this is already telling. I'm looking at the poll numbers, and there are 0 people that are +1s or +2. So that is definitely telling here. I've got about 20-ish% at a 0. I've got 53% at a -1, and I've got the rest at a -2. So our traders that are here live as a whole, they are probably a little bit more bearish than I am. I'm ready to go there. I'm ready to go to -2. I need that candle. I need that candle. And look, the day is still going on in the markets. If we end up giving up all of this gain back, and boy, we've already slipped about 0.5% on the NASDAQ since I've started this session, then we could actually go to a -2 somewhere later today. But ultimately, for the monthly outlook to change, I need to see a breakdown below the last swing low, and that is right here. Until it breaks this point, I can't get more bearish. At least that's how my system is. Once it breaks this last low, then I'm happy to go to a -2 on the month, and I'm happy to get more short. Very happy. I love to be short in markets. But until then, I'm leaning bearish. I'm more at the -1. So let's take a look at a couple of our trade setups we talked about over the weekend in the trading room, and then I'm going to open it up and have everyone share some of the trades they want to with the rest of the group, and I'll give you my analysis. All right, so Nvidia. We talked about Nvidia. We talked about tech being one of the better sectors. Even though it's still at a 0, it's probably a plus 0.5. And you can see here that Nvidia has held up really well this week. Just really, really well. If the market does break down, ultimately, this is going to pull Nvidia down with it. So if we get a break in all of the markets and we get a tumble, look, this trade just won't work out. It just won't work out, period. As much as we would like to think that it could buck the trend, 50% of what a stock does is based on the market direction. 30% on its sector and 20% on the stock itself. If these markets hold in or even have an up day or two, the stock's ready to go. This stock is ready to go. It is clearly showing outperformance. We have the 275.50, 245 bull call spread. Basically, we need a 5-point run. This is a 2% move, and you can see this thing easily moves 2% in a day. We've got 2 weeks left on this trade, so there's lots of time here. But ultimately, this one is holding up really, really well in a down week. So that's really good to see. One that is not holding up well is we had a bullish bet on US Steel. Now, it was a chicken bull. It was a diagonal call spread, so 29.32. So basically, we're saying, okay, we think it's going to be up here, but we don't want to be all that directional. So we did a diagonal call spread at 32. As you can see, this thing has pulled back. This thing has pulled back all the way to 29, and we're probably sitting at a mild to moderate loss here at 29. We have a diagonal call spread. So if this thing can bounce back up into this area, we're going to be very happy if it can bounce back up into our break-even profitable area, because then we can make a decision on Friday as, okay, do we want to continue to hold the long call? Do we want to turn it into another diagonal? Or do we want to just bail on it? For me, this 50-period moving average is very important. If it can't hold that 50, I don't want anything to do with it, and I will be out. Until then, it's a diagonal. I've got positive theta, and I've got very mild delta against me. If it can hold in here, very, very happy to just sit and wait on it. And on the short side, we had a bear call spread on Walmart. So this was the trade, a 139, 142 bear call spread. And you can see we are already below our max gain point. So 139, it needed to break below that in the next 2 weeks. It did. With these, I know myself, I hold these till expiration. If I'm going to be purely directional, I do other strategies where I can go in and take my profits. But when I just want to put in a trade and let it run, I use vertical spreads and some other strategies. So as far as right here, right now, this trade looks great. If it closes here, not this Friday, but next Friday, it will be a max gainer. It'll be a great, great trade. But we still have a lot of time left. So I chose a vertical spread, which means I don't have a ton of profit here at the moment. I've got a little bit of profit, but I will have a good profit at the end of this trade on March 17th. I'm not ready to do anything yet on it. So I'm going to be sticking around here in this trade. All right, so let's kind of wrap up this week, and then I'm going to open it up here. So please send me any trades you want to take a look at, anyone you want to share with the group. We do have the payrolls report. So we have the payrolls report, but at this point, we're still kind of stuck. We're still kind of trapped between our moving averages. Until that changes, there is nothing, really nothing to do here. So take a look. If you guys want to look at some trades, please share those with me in the chat, and I'll pull them up. We did one trade. I sent this out. This trade on Silvergate Capital. This was one of our trades in our trading room. And we talked about how this was one of the crypto banks that was facilitating transfers between US dollars and crypto accounts. They came out and suspended their guidance, which pretty much means you're out of business. So we opened up a 5-7 bear call spread. As you can see here, the stock is clearly below the $5 area, but it's at $4.93. Same thing here. It has a okay profit at the moment, but whenever you do a vertical spread, that profit really comes in at the end of the trade. You could take it off now for a small profit, or you could take a look at it and say, am I willing to hold this until March 17th? And if it closes below 5 on March 17th, you're going to have your max gain. The reason I do vertical spreads is so I don't have to manage them. I don't have to sit there thinking, ooh, should I get in? Should I get out? Should I take profits? Should I take losses? I don't think about that at all on my verticals because I just hold them all till expiration. So for me, this Silvergate Capital is looking really, really good here on the downside. All right. It says you can't see my chart. Okay. All right. Did that help? Can you guys see my my screen here? Okay. Sorry, I'm new to this. We don't usually do the polls on the weekend, so I didn't know I had to actually shut it down. Okay. Let's talk about trades that you want to take a look at. And I'll pull them up and we'll analyze them and we'll talk about some potential option setups. First one I have from John is on China. All right, so this is the FXI. And the FXI is the Chinese ETF. It's a large cap holding here. And this China story has been a real fascinating story. And I'm going to go back a little bit because I want you to see the damage that has happened to the Chinese stock market over the past couple years. From a high of 54, this is the ETF here, we went all the way down to a low of 20. Do the math real quick. A 34-point loss on a 54-point ETF is about a 60% loss. The Chinese stock market lost 60% of its value in about 22 months. And this last part was really about the real draconian lockdowns they had in all of China. And then I'm sure you've heard the news. Back in December, they came out and said, okay, we're not just going to ease out of it. We're just bailing on it altogether. And COVID shot higher and really spread all over China. There was all these reports, not from the government, of course, but all these private reports of people getting really sick and dying. But the stock market is a cold SOB. It doesn't care about people's lives. It cares about corporate profits. And that was a positive story for the stock market. So we went from 21 to the bottom, all the way up to 33. So that's a 12-point gain on a 21-point ETF. That was about a 55% gain in the matter of 2.5 months. That's monster. When an ETF goes up that much, that's a monster gain. So we had this huge exuberance, lots of short covering, and then all of a sudden it petered out. And you can see that we came down here and we went down below our 50-day moving average. We got a little bit better expected manufacturing numbers. So we got a pop from 28 up to 31. That's about a 12% jump. Whenever you have these downtrends, and the big question is the China market going to go lower? And that's the bet here on this trader. And they're looking at a 28-29 bear call spread. And I think that is a great way to play it. So going out, basically 7 or 8 days until March 17th. And look, you're going to get in 50 cents probably, and you'll have risk of 50 cents. So this is a straight 50-50, 1-to-1 trade on a vertical spread. And the reason I do like these trades, and I totally agree with this trader, is that this is just a no-brainer. Like, you don't have to think about this. So let's say that news comes out of China, it's fantastic, and the stock blows all the way back up to 31. There's no decision to be made. They've already lost 50 cents. They've quantified that's all they're going to lose. So there's no decision to be made. There's no panic. There's no, fear. There's no anything. It's just done. Or the Chinese market continues to go down and it goes down below 28 and it's a max gain. That's why I love these verticals here, especially on some volatile stuff. So I do like this trade. And I think that if you want to take a look at other countries, as I said, we've got WZ, I believe, is the Brazil ETF. I think if you want to take a look at some international stocks to possibly add to your bearish trades, I think they look probably better than U.S. stocks. So this here is the EWZ. And we've got a nice, what is this, from here to here? Probably got a nice 4 or 5% rally that we can sell into on the Brazil ETF. As you can see, the Brazil ETF is a little bit stronger than China. So I would be leaning more towards the Chinese ETF. But I think they both look good here. All right, next trade here. All right, the spiders. Okay. So sorry, I'm just reading this question here. Okay, great question, Scott. So I'm going to paraphrase and shorten up Scott's question here on the spiders. So next week we do have a couple things happening specifically on the markets. Every 3 months, March, June, September, December, we have what's called quad witching. So quad witching is where you have index options, stock options, commodity options, and bond options. Everything is expiring on that Friday. We typically see bigger volatility going into that announcement. We also get dividends that are paid out on the spiders. And sometimes that can actually have an effect on the stock on a very short-term basis. Again, this is very short-term. So the question is there some edge to be had by analyzing these periods of times? And, this is where I just love looking back at back testing. So what you're going to want to find is, again, as I said, December. You want to find the third Friday in December, which is this candle right here. So hopefully you guys can see where I am here. Was there a big move going into that? And was there a big move after? So the answer is there was a big move going into that. There was not a big move after. Let's just go back. These are the things I love to just think about. The next date will be that third Friday in September. Okay, September, right here. Okay, this is the third Friday in September, September 21st. As you could see, there was sort of a move into it. There was a lot of things happening at the time. This is the hard thing to do, is you're now trying to isolate one reason the market did something when there's always 1,000 reasons. But you can see after the quad witching, there was a big move to the downside. There was a big move to the downside. So this one had a big move after, not before. The other one had a big move before. This is where you could go back, and I can't tell you how many times I've done this in my life, and thought that I had some sort of edge or some sort of thing that I could figure out, only to find out that the information I had was inconclusive. So I'm going back here to June 17th. As you can see, we had a huge move before it and a big move after it. So as you can see, I'm going to just cut this because you can see we could go on this forever. The question is, when you take a look at something like quad witching, take a look at something like a dividend, I think it's very difficult to definitively say that this caused X to happen. I think you're much better off looking at the chart. Just looking at the chart at that time and making a decision off of that. Now, the good thing, when we go back in time, you can see that the charts were pretty accurate. In September, we were already in a downtrend. The chart broke lower. In June, we were already in a downtrend. The chart broke lower into it and then had a bounce off of it. I think it really all depends on where we are in the pattern to what kind of move we get. So I'm sorry I can't give you a definitive answer on that one, Scott. I can just say trade the chart in front of you. Just when you make your decisions, pull out all your trend lines, look at all your support resistance, look at your moving averages, and you're going to make your best decision you can. That's trading. And then you size for position sizing and max loss, and you see what happens. None of us have any control of what happens in the next second, minute, 2 weeks. Zero control. All we can do is make decisions that put odds in our favor. That's all trading is. And I always say this, it's like throwing enough you know what up against the wall and seeing what sticks. And of course I meant spaghetti noodles. All right. But again, I throw trades up against the wall, and I do it in a way that has an edge, and not everything sticks, but enough sticks that by the end of the week, by the end of the month, by the end of the year, it's a nice picture here. So sorry I couldn't help you on that one. All right, next trade is in the consumer discretionary sector. Okay, so this is the XLY. So here we have the XLY, and I think it looks a lot like the Russell. Remember, the Russell was already down to its 50-day moving average, already down to its last support. So for a trader looking for where is the weakness in the market, I think you've nailed it. So great job. I think you have identified where weakness is. So this is where bearish trades should be entered here, is in consumer discretionary. Now, you could, of course, trade the XLY directly, which is just perfectly fine. I would do something like a 140, 144 bear call spread. Again, this is another 50-50 1-to-1 trade. You're basically splitting your spread. So if you do a 140, 144 bear call spread and the stock's at 142, you should get a credit of $2, have max risk of $2. It's 50-50 1-to-1, and now it's just a pure delta play and where the stock is on March 17th. Now, if you want to do a little bit extra work, this is where I love screeners, and this is what we do at Maverick. So you guys are not new to this. But when you identify a sector that you say, hey, I like XLY, okay, but can we identify a stock inside that sector that's even weaker than the average stock? And that's what we do. So I'm going to go here to consumer cyclical. I'm going to go to the scanner, and I've got my scan to only do stocks that have average volume of 2 million and are over $10. It's a pretty simple scan. And then I just hit the performance button, and then I'm going to see what has been the weakest stock over the past quarter. And all of a sudden, now it gives me stocks like Rivian, GameStop. We actually had a bearish trade 2 weeks ago on GameStop that's going to end up being really good. So this is where I think you start. If you've identified that XLY is weak, you could trade XLY. And here's the good thing. If you just trade XLY, you don't have like news risk, if that makes sense. Like, let's say that you decide to go short Rivian. All right, I'm going to do a short on Rivian, and I'm going to, let's just say you just go short, or you buy puts or whatever. At any time, news could come out on this stock. Rivian could announce that their truck cures cancer somehow, and the stock jumps up. You have to react to that, and that can cause moves, that can cause mistakes. If you just do the XLY, whatever happens to Rivian doesn't matter. And so you are insulated against this, I call it single stock risk. And so I do like just playing the ETF. It's very, very simple. And you don't have the news risk and the single stock risk. But you also are going to get a muted move because they have hundreds of stocks in their ETF. It's going to be a more muted move. So if you like low volatility, then I say stick with the XLY. If you like slow, steady wins the race kind of trades, XLY is perfect. If you want some more, I don't hate the word excitement, but let's use the word volatility, and you're going to be using strategies that will take advantage of the volatility, then this is where you start. These are the worst stocks at the moment. The question is, are they going to continue being the worst stocks, or are they going to somehow turn around? And this is where you just look at charts. You just take a look at charts. There is nothing in this Rivian chart, absolutely zero, that is telling you that this stock is going to turn around. Now, that doesn't mean that's a perfect entry right here. I think entering off of bear rallies seems to be the best entry. So I would put this on my watch list for this week. And if we get a pop up to 1650, oh man, and we get something like this little shooting star doji, I'm in. I think this one looks really good. But again, like I said, you're doing some more work. You're waiting for things where just with the XLY, it's kind of a no-brainer. Here is GPS. Gap store looks pretty bad to me. These are the kind of candles you like to see. We did not bounce. So these two candles right here were Thursday, Friday of last week. This did not participate at all. And then this week, it's just falling apart. So for me, if you want to go inside of the sector, GPS gap is a great short. I do something like an 11-12 bear call spread. That's going to be mostly delta. So you're going to get in probably about 70 cents of credit, have about 30 cents of risk, and that's about it. All right. So again, great question here on that one. All right. Does anyone have any sideways trades? Any sideways trades anyone wants to share? All right. Jared asked about VALE. All right. VALE is a mining stock. So it's in the materials sector. And if you don't know that, Finviz is great because you simply put in the chart and it says, hey, dummy, this is basic materials, metals and mining, and it's from Brazil. Okay. It's very quick to learn that. So let's talk about this sideways. Okay. I did a session years and years ago. I don't even know where it is on the website, so I apologize. Our library has grown quite large over the last 20 years of doing this. There are two things. There is consolidation and there is sideways. So the difference between the two, sideways is listless, being blown around by the wind, not really going anywhere. That's sideways. Consolidation is building energy for a big move. So when things have, let's say a stock goes from, 13 up to 19, you would assume that there's going to be some break from that run. And so we got a break from 19 back down to 16. And yes, you have moving averages that are flip-flopping, but this to me looks more like consolidation. Building energy for the next move. I just want to kind of show you maybe another trade when I want to show you what the differences are. So we had this big burst of energy and now we've had this contraction of energy. This week on the trading room, we talked about Schlumberger as a short. Sorry, as a sideways trade. So here we have a stock that it had a big burst back in September and it reached all the way up to 55. And then since then, if there was going to be another big major move, it would have happened after a couple months of consolidation. You can see it didn't. Now you can see we're now more listless. This is now more, okay, we lost all the run and now we can't run any higher. So I think the VALE is one you want to actually take a look at something else because I think that's more consolidation getting ready for another run than listless and out of gas. And not just out of gas, but doesn't look like there's any clear direction on it. So great question on that. All right, got more sideways stuff coming in. All right, let's take a few more. Procter & Gamble. And let's kind of put this through the test that I just talked about. Listless or consolidation. Procter & Gamble, who typically is a very boring stock, has actually become fairly exciting. This range that we've seen here, 150 down to 125, back up to 155, ultimately this is sideways, but I want you to see it is making big moves. That's the first thing that's kind of telling me that, okay, maybe PG isn't just listless. Maybe there is some underlying movement going on in it. We're moving, 25% every couple months. We're right in the middle of the ultimate range. If someone said, Rob, I'm going to open up a 125, 140, 155 butterfly. Okay, that totally makes sense to me. Totally makes sense. But I think we are more just, like I said, this thing to me doesn't really look like it wants to stay still. Right now, yes, you're exactly right. It does say it's staying still. But this to me is, we've had a lot of energy. Are we building here? To me, I would look for something else to see if we can get something a little bit more listless. Let's see. Mesman gives us CSX. Oops, there's my dyslexia coming in. CXS. CSX, geez. All right, Railroad Company. Okay. This one I like a little bit better. As you can see, we have moved down, we moved up, we moved down, and then now we're just kind of going sideways here. But I do have to say, we are going sideways here with a little bit of downward pressure. If I did a butterfly, I would want to be slightly bearish on this. So I would do something like a 29 as the target. So I would do like a 27, 29, 31, or maybe a 26, 29, 32. I would want to be down more in this area just because it is sideways, but to me, it's got a little bit more bearish feel to it. Again, I would just want to reflect my target price with this channel of the stock. But yeah, I can get behind that. All right, Jason, we're having a ton of sideways ones come in. Thanks, Jason. We got Kroger. All right, Kroger has been one of my favorites of sideways stuff for a while. And so if you take a look at the last 5 days, we've had a burst of energy. And whenever we get bursts of energy on Kroger, you can see that, typically it's followed by more energy. This to me, I don't like that burst of energy over the last 5 days. Remember, sideways stuff, you want it to be listless, not exciting. You want it to be boring, not really cranking higher or lower. I like this one a lot, and I've done lots of sideways stuff on Kroger in my career. But to me, right here, right now, the question is there an easier trade? Is there an easier trade? All right, and Michael says maybe the easier trade is Tesla sideways. Boy, I don't know. I'm sure I have at some point in my career, but I can't remember ever doing a sideways call on Tesla, because Tesla's almost always trending. It's almost always trending. And the only time it isn't trending is after a huge move, 380 down to 200. And then we got a month and a half of sideways action. And then we took off and ran higher and got 1.5 months of sideways action. And then we had 7 months of trending down and then 2.5 months of trending up. To me, this to try to call where Tesla is going to be in 3 weeks, I don't even try it, because I don't think I can do it. I don't think anyone can do it, to be honest with you. So I'm going to say no on this, because I think this stock is just one that the name of the game on this stock is volatility. And with the butterflies, based on how you structure it, you don't really get paid for additional volatility. If you were like a naked call and put seller, if you were doing like a short straddle, all of a sudden you get paid for the volatility. But because you're doing a butterfly and you are, buying, capping off those ends, that risk, you're capturing a little bit of volatility, but not much, because, the at-the-monies are going to have a lot of volatility, where the ones a little bit further away that you use to hedge are going to be less, but you're still not going to be capturing the whole thing. So for me, I don't like it at all. And Mesman, you're right. I think it's going to be a little bit better of a diagonal play. If you did want to play sideways-ish on Tesla, a diagonal spread to me would be a superior way to do it. All right, awesome. Oh, I'm having fun. I see why Joe loves this. Joe loves to do this class. He just loves it because it's so much fun. All right, any other trades we want to take a look at before I let you go? All right, last one. We'll wrap it up. From Garrett, we got Pinterest. Sticking on the sideways story, look, this is sideways. Now, again, this is Pinterest. Pinterest in the past was a big mover. So if we go back in the chart, you can see big movements, big volatility. And you can see that after a little bounce here off the bottom, it's been very listless. And so I think you've nailed it here on Pinterest. I think this is exactly what you're looking for. The big question is, where do you want your profit point to be? Me, since I am more bearish than bullish, I would want to have my profit target to be lower than the current stock price. So for me, either like a 24 or 25 would be where I put my midpoint. So maybe like a 22, 24, 26. That's probably a little tight. So let's call it a 22, 25, 28. I think that for a butterfly, I think that looks pretty good. If you want to shift that down $1 and go 21, 24, 27, I can absolutely support that too. But I think you want to be probably $3 spreads on this one. This one still has enough volatility in this range. I think a $2 butterfly is going to be a little tight. That's going to be like you got to hit the bullseye on the dartboard. And that's really tough to do in trading, especially on the exact date of expiration. That's impossible to do. I've done it once in my entire career. Have I actually had a stock that closed exactly at my max profit point on a butterfly? The irony was I didn't get the max profit because I had to bail on it because, again, I didn't want to get exercised. Now, typically you just close one leg. You know, if you say, so let's say that this stock, I've got a 24 butterfly, and let's say on the third Friday of the month that it's expiring, the stock's at 23.50. Well, I know I just have to close my bearish side of the butterfly. I just have to close my lower leg, and my upper leg will just expire. And if it closes at, looks like it's going to close at 25, I got to close my upper leg and let the lower leg expire. So you only have to close one of the sides. If this stock was going to close right around 24, and you didn't want any risk of exercision over the weekend, you got to close both legs. And it sucked. It was kind of the irony. I'm like, oh, you don't want this. You don't want this to be anything. All right. Sorry, I have more trades come in, but I don't have time to take them. So this was fun. I do have a question about a summit this year. We took a look at a summit early this year. And if you remember early in January, inflation was raging. Actually, sorry, we took a look at this in like November, December. And when we took a look at hotels, catering, events, and everything, it was going to be about 80% higher than the cost of our last summit, which was in 2021. So because of just cost, we said, hey, let's let everything calm down and let's reevaluate this. We are looking into the possibility of having a fall summit in 2023, but that is going to depend on our ability to control costs on this thing. So we will get back to you on that one. All right, I'm going to wrap this up. Thank you so much for joining me. Everyone have a great rest of your week, and I'll see you later. Goodbye, everyone.